Welcome to this Killik Explains finance video. This week, let's take a look at some stuff that's been appearing in the financial media recently, certainly of interest to investors, and a space that you need to keep an eye on as we move through the rest of the year. So it's the market stress measures investors need to watch. And I reckon there are three biggies. Now there are loads more out there. This is my current top three. Okay, what are they? Quick overview. So we need some early warning signals that market stress levels are rising. All right? And if we're going to look at three in particular, we're going to have to take a view, an educated view. And an educated view says this: yes, in combination, changes in all three, as we've seen during the first half of 2018, could be evidence of market stress. But equally, there are less sinister than the press sometimes argue reasons why these move. And you need to know those too, so you don't suddenly panic, alter your portfolio allocation for no particularly good reason. Now then, let's take a look at these. The early warning trio, as I've called them. First of all, the gap between LIBOR and the OIS rate. Easy for me to say, full of jargon, actually not too bad to understand once you know roughly what it is. Number two, the 10-year government bond yield. And we're looking for changes in these. That's what we're after here. Not necessarily the absolute level, it's the change that matters. Number three, the level of the VIX fear gauge. So, taken in combination, this can represent a fairly scary trio, but equally, you do need to break it down, look under the bonnet, as I'll be doing in a moment, and just ask the question, are there other explanations than kind of pure market stress that might actually change your interpretation? So, here we go. Number one, LIBOR-OIS spread. Now, I'm going to condense a lot of science into a quick snapshot description here. What is this thing? It is the difference between something called the London Interbank Offered Rate, LIBOR. That, in a nutshell, summarising slightly, reflects the rate that banks are prepared to lend to each other at. Now, there are lots of different rates in different currencies and so on. The one I'm focusing on here, which normally forms the basis for this spread, is the so-called 90-day or 3-month rate. Now, what are you comparing the rate that banks essentially prepared to do business with each other at? Well, basically we're comparing it to the overnight index swap rate. There it is, OIS. Now, what is that? Again, summarising slightly, the calculation varies very slightly from jurisdiction to jurisdiction, but it represents, if you want to see it this way, a rate at which a central bank, like the Federal Reserve, is prepared to do business in funding terms with commercial banks. So, because it's a rate that the central bank has some influence over, it's normally a bit lower, albeit not by much recently, than the rate at which the banks are prepared to do business with each other, taking the central bank out of the equation, if that makes sense. So, it's two rates. So what so far? Well, basically the spread is the difference as a percentage, or basis points if you prefer, and it's that spread that people watch. Why? Well, let's look at some latest readings. Recently the gap's been incredibly small. Very, very small, just 0.1%. In other words, the gap between those two rates, almost non-existent. Recently it's reached 0.6%. This is what I mean by relative changes. 0.6% doesn't look like much, but actually in the context of where that spread has been recently, that's a big jump, that's a big spike. And it's the widest spread since the financial crisis when it peaked at 3.65%. Now we're some way off that yet. That number and that number are in relative terms nowhere near that, but people have started to say it spiked recently, it spiked quite quickly. What's this all about? So is this basically a blip or the start of a new trend? And what trend would that be? Could it be that banks are suddenly getting more and more nervous about doing business with each other? And what ramifications could that have if that kind of fear factor spreads? Now, that is the kind of almost the media watch out, things could go wrong at any moment argument, but actually, as I'll be suggesting with all three measures, there are other explanations. So for this one, for example, the LIBOR-OIS, a flood of treasuries to fund tax cuts and spending in the US in particular may have simply dented demand in the short term for bank bonds. All right? And that's a sort of structural, technical factor, doesn't necessarily mean that the world's about to end, if you want to see it that way. Number two, companies are investing and spending, so are buying fewer bank bonds. Again, that's a structural factor that will influence rates, including that spread, potentially. And that's not bad news. Companies are investing and spending. That's a sign of economic confidence, if you like. That's not, a fear factor at work reflected in that spread. And thirdly, market jitters may have simply forced investors short-term into low-risk funds, which tend to hold treasuries. That's going to squeeze, insofar as you can squeeze it any further, the yield on those treasuries and potentially affect the spread. Because that spread's going to move if you get the top yield LIBOR, if you like, moving up, or the bottom one, the OIS index level moving down, if that makes sense. So you could be seeing just a reflection of several simultaneous mechanical factors that have, in the short term, pushed that spread out, but don't spell doom and gloom. And that's my message here. Interpretation is key. Now, number two, the Treasury yield. This is more straightforward to understand, so we can use a chart here. So this is a key yield. US 10-year Treasury yields uses the benchmark for rates all around the world, for debt and also equity, in the sense that this rate forms the basis of something called the equity risk premium, and that's an important number in the context of, what do investors expect to get from equities over and above something like a rock-safe government bond, and that has important implications for the price of equities and so on. So it is a key yield. Now, why have I put the red on the right-hand side in the bubble? Well, it's this reason. It is seen as a key benchmark, this rate, and the key number, which is sort of here, is 3%. In other words, now 3% is just a number. It's just, it's not a magic number any more than 1% or 6%, but it matters. And the reason markets and the media have picked this up is because it represents a 4-year high. So once you're through 3%, you're at a significant level. Why do we care about a 4-year high? Well, in late 2013, early 2014, all right, we saw a bond market wobble, the jitters. Bond markets got nervous, if you like, panicked a bit when 3% was tested. So people are saying, are we back in that sort of territory? And what happens, we get a really proper, serious panic this time. All right, so it also coincides with rising commodity prices. The oil price is more than double where it was not so long ago. That doesn't help people who look at this and think, ooh, we're getting back to a level where the market could be getting nervous. Now, that's the kind of bear case. That's the doomsters. But again, you can look at the other side of this coin. So, having it 3% last time, if history is a guide to anything, it rapidly fell back to 1.26% in 2016. So yes, it's peaked towards levels we've seen recently before, but it didn't then carry on marching north, it went south. So calm was restored, if you like. Number two, rising rates can reflect buoyant growth expectations. Could it be that actually the underlying US economy is doing quite well at the moment, and actually rising rates do not reflect the end of the world, they reflect quite the reverse. The fact that it is normal to anticipate that rates will rise, yields will rise when the economy is starting to show some genuine signs of picking up. And number three, without an inflationary surge, if you're a historian, stock market historian, stocks have often coped quite well with rising yields in the past. Now, all bets are off if you get a massive spike in inflation, but assuming you don't, rising yields do not automatically spell doom and gloom for stocks. Quite the reverse sometimes. So, there's number two. Number three, the VIX. A slightly different indicator this time. This is more directly an equity market indicator. It's an index, I've talked about it before, which captures what's happening to the price of equity protection, the cost of insuring yourself against a crash, if you like, in the equity markets, because it uses the price of options. Now, there are different versions of the VIX. There's one for the US, that's the one people quote the most often. There's also one in the UK, and so on. So you get them for different markets, but essentially, here's the logic. It's seen as a proxy for how fearful the market has become, because it reflects the cost of insuring yourself, if you want to see it this way, against a market crash. The more expensive the insurance, the more nervous the markets, the higher the index, is the way it works. And what's got people worried is this spike here. And we seem to have reset at a somewhat sort of slightly higher level than we were at before. So the VIX has trundled along as a measure in the sort of low teens for ages, you can see on the chart there. Then suddenly a massive jump into the mid-30s, around February time, and then it's settled back. Well, it hasn't completely settled back, it sort of drifted. It looks a lot wobblier, and it's reset at a slightly higher level, it seems, than it was before, and that's got some market watchers nervous. Now, fine, but actually, if you were to look back at the VIX as a predictive tool, you'd say it's not that great. It really only reflects what has happened. It's a rear view mirror indicator, and that limits its usefulness, especially in isolation. In fairness, I'm suggesting you use it not in isolation. An increase or decrease in volatility may reflect upside surprise as much downside. People forget this. When volatility moves up, it could be that the markets are going crikey. Actually, reporting seasons look pretty good, better than we're expecting. Economic surprise index is down in the sense that people are getting fewer surprises, fewer shocks than perhaps they expected, either measured on the upside or the downside. It can reflect a sudden increase or surge in confidence. So positive economic news can temporarily unsettle the markets, if you like, as much as negative news. But that side of the story is often not picked up when people talk about volatility increasing. And the VIX is way off, thank goodness, where it has been way back in the distant past. So we've seen it, in context, hit levels of 80 plus let alone your 30 plus back in February, and we're some way off that yet. So all three of these indicators well worth watching, but all three of them have more than one explanation for moving. And that's the key point here. Interpretation is everything. So be careful how much you trust the headlines around these things. Now, quite a lot of ground covered, and there's quite a lot more to know, quite a lot more science there. So editor@killik.com for any questions, and killik.com/learn if you'd like to see videos that take things on the VIX a little bit further, 10-year Treasury yields, and so on.